If we're looking at the interconnectivity of markets, I think first of all, volatility is an absolute key component of that. When you see periods of heightened volatility, all asset prices, or most asset prices, will move in lockstep. You'll see greater correlations. A rising tide will effectively lift all ships. And when you get a period of very low volatility, stock pickers can have much more better field day. You're not going to see a situation where all stocks moving up and all stocks moving down based on this risk on, risk off thematic. You can actually say, this is a quality company, I want to be leveraged this because of X, rather than just risk on, risk off. But if you're looking at interconnectivity of markets, the thing that really gets to me is how the bond market will influence the US dollar. We look at yield spreads, for example. What is the yield premium that the US Treasury commands over the Australian government or the European government bond? And as that moves up in favour of the US Treasury, it puts upside into the US dollar valuation. How does the swaps market play into US dollar valuation? How does US dollar moves play into the equity market and obviously commodity prices? How do commodity prices play into credit markets, the debt markets? And what does that mean for equity markets? So everything sort of moves around in circles. One asset will impact another asset, and again it feeds into the idea that when one asset hasn't done what it's supposed to have done, us as traders can take advantage of that. It's supposed to have done X based on this prior move, and you get misalignments in markets. And I think that's the really important thing, how the dollar will impact one market and just how interconnected everything is. If I was to put my pure technical analysis hat on, I mean, I couldn't care really what one asset's doing. I'm just looking for the highest probability setup that I can possibly find and applying a risk management strategy and money management around that to again heighten and extract that, and of course how you manage emotion around that. But for me, probably the most common denominator that we've been seeing from markets over the last 3 or 4 years, perhaps a bit longer, is really the perception of how economics drives central banks and how central banks will dictate market flow. I mean, everyone is using central banks as their guide for prosperity effectively. Will the ECB come out and lower rates even further? Will they look to increase their balance sheet purchases even further? Will the Bank of Japan do more? Will the Federal Reserve raise rates by X amount over the next 12 months? Who knows? The market is just trading around the expectations around that, and how the dollar trades will affect how commodity prices trade. Commodity prices will affect how credit trades and equity prices trade. So really for me, the central focus is around the perception of what central banks are doing, and all asset markets are really dictated to by the perception of that, and technical analysis will go along for the ride.